accounting to be sort of this necessary evil for getting your business degree. Also true if you're a marketing or a management major. But the financial statements are useful sources of information. And in courses like investments or even in corporate finance, we're not really interested in some of these financial statements for the sake of doing accounting work. We're interested in using them to analyze a company, to determine their financial position. And in coming tutorials, we'll talk about doing things like financial ratio analysis. But let's look at the two basic financial statements that you use most commonly, which are the balance sheet. The balance sheet oftentimes is referred to as a photograph or a snapshot. That is, you add up the amount of money. You'll notice from this PowerPoint slide I have here, on December 31st of 2009 and 2010, this company had a certain amount of money, which is in millions of dollars, in their account. And the way the balance sheet works is it looks at your assets and your liabilities and owner's equity. Owner's equity being whatever asset, you take the assets and you subtract out what you owe people, the liabilities, and that's what belongs to the owners. Okay, oftentimes you hear about home equity. Okay, equity in your house. You have a house that's worth $400,000. You owe $80,000 on the mortgage, so you have $320,000 in equity. So the first thing about the balance sheet that we should note is it's called a balance sheet because it has to balance total assets down here in 2009, 2,756, okay, and that's in millions, so that would actually be 2,756,000,000, has to equal the amount of total liabilities and owner's equity. It balances. You'll notice for 2010, it's 3,112. It's also 3,112 on the total liabilities and owner's equity side. So it has to balance. The way the balance sheet is laid out is that we start with the most liquid assets, cash being the most liquid. It's already cash. And then accounts receivable, inventory, and then we move to fixed assets. We move to, plant and equipment, okay, land, things like this. This is a simplified balance sheet. We'll take a look at a real financial statement from Morningstar so you can see that it looks a little more complicated, but it basically follows this format. On the liability side, we have accounts payable, notes payable, we could have taxes payable, and then we have the longer term liabilities, long-term debt, and then you have owner's equity, retained earnings, etc. Okay, let me jump to the income statement. Okay, most of this should be somewhat familiar to you. The income statement is something we'll use a lot in investments as well as in corporate finance. And what this does is oftentimes this is referred to as a movie, a video, because it shows not a snapshot in time. If you look at the balance sheet, we can see how much money you have in the bank on December 31st of 2009. When it comes to selling stuff, we don't look at how much you sold on December 31st, 2009. We look at how much you sold from January 1st of 2009 till December 31st of 2009. We're looking at what you did over an entire year